Hello again, my name is CryptoKib and welcome back to this course trading indicator. So let's continue from where we stopped the last time, and the next slide is momentum and strength indicators. So sometimes these two names can be confused to mean the same, right? When we say momentum and then we say strength, we can as well treat them as the same actually, but the truth is strength refers to the weight in buying and selling pressure, while momentum is the speed at which price changes. Most times, both are correlated and used together, as strength indicators measures the weight of oscillations in the buying and selling pressure. Momentum reads the speed at which the price is being performed, at which the price action is being performed. So due to this, both can be referred to as oscillating indicators. Examples of strength indicator is the relative strength index, the RSI, and the stochastics. And the example of the momentum indicator is the moving average, convergence, and divergence, MACD. Many of you must know the RSI, stochastics, and the MACD because they are the most commonly used indicators alongside with the moving averages. So these indicators are settings where you can configure them to your needs to either be fast or slow, which means short term or long term. Like we had also in the MA, we had the shortest number, which is a short term, and the largest number in the settings, which is a long term. It is the same thing as with momentum or strength indicators. Most time these four settings are okay, as this is what many other traders uses. There are several ways to use a strength indicator, one of which are the oversold and overbought indication and divergence. Divergence is when the price is making new highs while the indicator is making lower highs, or when price is making lower lows while the indicator is making higher lows. The ways to use the MACD is not different, only that there is no oversold or overbought regions, but rather we have crossovers of the MACD moving average as well as the MACD histogram, which is a representation of the momentum of price. So MACD acts both an histogram and its own moving average. It has a special way of calculating the moving average, but you can all change the settings in the MACD settings. The histogram is a representation of the momentum, which is the speed at which price is changing. It appears in a form of volume. Some people refer to it as volume, but it is not volume, it is momentum. You can as well spot divergence by using the MACD histogram. I made a mistake by writing history here. MACD histogram or the MAs. I will show you how to do this. The stochastic is no different either. It has a crossover and an overbought and oversold region, and can spot divergences as well. So let's go back to our charts and spot how we can deploy the RSI, the MACD, and the stochastics, and now we can use both or triple of them. So here we are on the chart again. You remember how to deploy the indicators, right? Coming to the indicator tab on TradingView here, clicking on it, then here search either the RSI or relative strength index. You have it here. So let's start with this. If you come over here, you can see the settings, right? Here is to hide. If you want to hide this, you say it's no longer displaying, you hide. Then here is the settings. You click on the settings. Then here you have the inputs. Here it is at the default settings 14. You can change it to 7. I will change it. I want you to watch the lines and see how it reacts the moment I change it. Can you see? It becomes faster, which means it becomes more sensitive to price. Let me change it to 2, then you see what happens. You see, it becomes more sensitive. So on a one candle, it moves, it can oscillate a number of times. But let me change it to 33, and then we see it becomes slower. You see, so the signal becomes more smooth and more long term. So if it gives you a signal here on the highest number, it's more of a long-term signal. But if you have 2 or 3 here, then you are working with a very fast number, which means 1 or 2 candles you can be up and down. Look at here, we are the oversold region, which is here, and down here we are here overbought, and down here we are oversold. Now here oversold, here overbought. See the quick movements on little price. And then let's go back to the default settings here. As you can see here, we also at overbought, but we are not yet at oversold. Whereas using the 3 as the settings, at this point we were at oversold. So you can see how it can be smoothed out. So let me go back to the 33, then we see if we see half overbought here. Okay, we have overbought here, but the point at which the RSI is has changed from when it was 14. It was around 64 here. If you look at the right hand side here, this is the oversold. This is the overbought line. It is at the 70 mark. Then the oversold line is at the 30 mark. The 50 is the mid-range. So if the RSI is above the 50 line mark here, let me try and mark it. Let me change this back to 14. So let me place a line at the 50 mark. That is the mid-range. So how do we use the RSI not to waste so much time on this video like I did in So if the price, not price in this instance as in the RSI, I don't use the indicator, so I'm not sometimes my is price sorry. So if this RSI line is above the 59 mark, it simply means that the market is bullish. Like we have right now, we have RSI above the 59 mark, so price is currently bullish, even though price is pulling back at this particular moment. And once price is below, once the RSI is below the 50 mark, price is bearish, like we have here. But then being bearish doesn't mean it can be extended. Sometimes it can be overextended and it will be full-blown bearishness, while sometimes it will just be bearish for a little while, only to cross above the 50 and find support on it. You can also draw trend lines on this and find patterns and co. So from this 70 mark to the 100 is the overbought region, whereas from 30 mark to 0 is the oversold region. So once RSI is inside of the oversold region, you want to look for buy signals. At moments the RSI is above the 79 mark, which is the overbought region, you want to look for sell signals. Looking at this, the moment this RSI crossed above the 70 into the overbought region here, what happened? Some people will immediately sell, right? Which means they will sell at this point, because if you take a ruler and rule this particular time, this eye, the first eye in the overbought region, this is where price was at that time. Just glance through it straight down like this. This was where price was at that time. If you have sold at this point, then you will be missing out on all this 100% move. And price remained in the overbought region and kept going high until this particular time, where it then dropped rapidly. It was a rapid drop from this point here. So if you want to sell at this overbought region, you have to have maybe other tools or other signals for you to know exactly when to do that. You can, the moment it comes into overbought, if you start selling from the moment it comes into overbought, like you are shorting the market, which is at this point, will you keep shorting the market from this particular point up to 100% move? No. Assuming you short at this point, 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 you will have shorted all the funds you have access to, and you will still be taken out of this market. This is why using the overbought and oversold region to as your buy and sell signal is not advisable, because it can come into oversold and then it will get extended. Now look at this. When price was oversold there, let me push it to the front. Here we have price coming as oversold there. Some people will have sold this moment the price was oversold there, and then what happened? Price continues to go up. Even RSI came back from the oversold region into the bullish region, and then entered into the overbought, into the overbought region again. And the moment he entered the overbought region, the first time was here. If somebody have sold there again, the price continues to go high. So what kind of reversal are you waiting for to see before you know when to sell or when to buy? Let me see if you can get when the price is in the oversold region. Okay, here we have price coming into the oversold region here. Some people will have bought here. If you were to ladder your buys here, the moment, because it's not extended in deep into the oversold region, so this will have been a good buy. But then, how do you use the RSI with its full capability? Using RSI with oversold and overbought is not the best way. As you can see from these examples, it gives false signals most of the time when you go short and price continues to go up. Here we have it coming into the oversold region, overbought region, which means you want to look for sell. If you have sold there, you'll be in small profit, but then what happened? Price reverse immediately. But then you want to buy back. If you sell at this point, you want to buy back when it's oversold at this point. If you have sold at this point of overbought from any region here, you will be in great profit here. But it doesn't happen all the times like we have seen. So how best can you use the RSI with its full capability? That is where we have the divergence. RSI is good at divergence. And what did I say? Let's go back to the slide. I said divergence is when price is making new highs while the indicator is making lower highs, as in price is making higher highs and indicator is making lower highs. Let me give you an example of it here. Assuming we have price doing this, we have price making this high, then maybe higher low and higher high, then another higher low and another higher high. This is a bullish movement, right? And then if we have the indicator doing something like this, it comes here making a high, then higher low, then here we see have an higher high with this one, which means they are correlated. But then at this point where the price makes a new high, the indicator did something like this. As you can see, if you are to rule this, we have, let me change this color. We have higher highs here, right? This high higher than this particular high. Whereas we have indicator, this high is this high, this low is this low. Then from here we made a new high, but from here we couldn't make a new high to the indicator, we made a lower low. So how will you draw that? When you want to draw the divergence, you draw the highs on the price, then you connect the highs on the indicators. So the price is making a new highs while the indicator is making a lower high. Another thing, for a bearish movement, when we have a bearish movement, the price is making series of lower lows like this, but then indicator will be making, we have indicator will make an higher low. So if you are to roll this, then the indicator, this will be an higher low to this, whereas price is making a lower low. This low is lower than this low. So there is an anomaly between price and RSI. That is what we call divergence. Let's go back to the chart. So can we spot divergence on this chart? Yes, we have one divergence already. And if I'm to take the trend line too, we see these lows making a lower low here. As you can see, this low is lower than this. Then what did we see on the indicator? we have this low is lower than this new low. So this new lows, if you have to double click it to expand it, as you can see, this low here is higher than this low. So what do we have? We have divergence in price. But then most times you do not want to use the low of the price to spot divergence. Most people use the close or the open like this. So you connect it to the close or the open again here. So we have a pure lower low here, and we have a pure higher low here. And the moment this divergence formed or happened, look at it here. We saw price moving, RSI moving from the oversold into the overbought, and price rally, making a rally from this particular lows up to a 28% move. Sometimes it doesn't have to go that far, but then you expect some reaction. So when do you expect to take trades? When you spot a divergence here. This is what we call the bullish divergence. When you see price making lower lows and you look at your RSI, the low that price made there is not reflected on the RSI or the indicator. It's only an higher low. That is divergence. Some people will suggest that when the highs, like this high, is broken on the indicator, this is the high of the divergence. The moment it breaks above, like here, the moment this breaks above is here, right? It broke like here, you know, here. It was clear from here, which is this candle. That is the moment you want to buy, because you can have a continuous divergence. Like you have price doing something like this, making an higher low, coming again, and then making another higher low here, whereas it will continue going, keep going higher, whereas price will only rise up a bit, only to make a new lows here. I hope we can see something like this in the chart. Let's look. And if you can spot a bearish divergence, we should see it. You should say, I don't even know how you're gonna say that. Okay, now look at this. We have this to this. We have this point to this point. That is what? An higher high. This high is higher than this higher high. Are we gonna see the same thing on the indicator? Let's look. We have this side, which is this side here. We mark it. Then we have this high. Where is it here? Here. And what happened? We saw blatantly it is a lower high on the indicator, whereas the price is making higher highs. That is an anomaly in price. That is an anomaly in price. The strength at which this price is going up is not reflected on the strength indicator. It's like, I don't even know the example to give. I don't normally prepare for these classes. I just prepare the slide. Once I want to do it, I just prepare the what to say and then come on it. So looking for example at times is a bit tedious, so you should bear with me. So the example is like when you have a ball at hand, or maybe you play football, then you hit the ball, just maybe you just hit it with low force, trying to get it away from you. Then the ball flies. You will be surprised yourself that I didn't even put a lot of effort into kicking this ball, but see the way the ball is flying. You'll be surprised at what's wrong. Is it balloon or is it so light? You understand? You'll be baffled. So exactly. So here, price became very light and it's flying on its own without reflecting the strength behind it. Just like I said when we were dealing with volume and price analysis. So price was going up, but then the strength at which the price is using in going up is becoming weak. So what happened? We saw it again, try to make an higher high, but it didn't. But when you look at the close, if you use the close, here we have a close, here we have another close, here we have another close. That means we have 3 higher highs by using close here. And then what happened here? We have this side, and this high. Price kept coming down while price kept going up. So the strength of at which price is going up is not reflected in the indicator, means there is an anomaly. And for there to be an anomaly in the market, you want to be wary, especially if you are looking at buying this market because you see it going up. And the moment this formed on the third time, what happened? We saw this big crash or this little crash. Then what happened at this size? From this particular last side to this side, what did we see? We saw that price made a lower high here. Now that is this side, right? So let's roll it here. And what did we see the indicator do to this side? If you look at the cross here from this side, you see it's this side. So what happened? We see the indicator here to here is lower highs and price is lower highs. So it is correct. I'm telling the same story. No divergence there, no nothing. So if you are short, you can still go short. Then looking at these lows as well. Here we see this low making a lower low, right? It is a lower low. Then this is a low here, this is a low here. What happened? Indicator seems also to be making a lower lows. So everything is correct. Not the time to look for buy, even though price still came up. Because if you look at price at a higher time frame, there may be a divergence playing out. So you have seen a bullish divergence. You have also seen a bearish divergence. I think I'm spotting one again. We have this size to this side, an higher high. Then this side means this size. Looking at the crosshair alone, you can see to here is making a lower highs. And what happened? Price came down. But then what happened again? Like I said, the moment you short here, it came down, it gave you that profit, right? But then it went up again to make another higher highs after a short drop. So from this side to this side again, it's another higher high. Now let's look from this point to this point and see what we have on an indicator. That is this point, which is this point to this point. And what do we have? We even have another lower low. So this high is higher than this, higher than this. While this high is lower than this and lower than this. So we have like divergence on two occasions. And if you can rule these ones with one straight ruling like this, sometimes this magnet features doesn't help. It doesn't quite fit, but then you get the scenario. This side by close is higher than this, and this is higher than this, and it is the same thing you have here. And some people will say at this point, here is almost as a mid-range, which is this point you want to see them to break before you short the market. And when did you see that break? It was around here, and that was when the drop happened. If you had shorted there again from spotting this point to this point, which is this point to this point, it gave you little reaction, only to come again and make like equal highs. Is that even an equal highs? Let me measure the close again. It doesn't seem like an equal high. It's a bit of higher high, a little higher high. This shapes, yes, higher high. This is higher than this. And when we look at the indicator at this particular point to this point, this which is here to here, we saw another divergence again, which means we have like 3 or 2 or 4 divergence here. We have from this point to this point, that is point 1, this point to this point, which is point 2, and this point to this point, which is point 3. So 3 divergences in a row. If you had shorted the moment you see this one, you will get a little profit. If you miss this, and then you spot the divergence from this point to this point, or let's say from this point now to this point, and you shorted at this particular point to spot the divergence, you have little profit. And then you even see another divergence here. If you have shorted at this last divergence now, you will be in a very decent profit. But how are you going to tell that this is a divergence that will play out? Why does this one not play out the same way this one played out? Why didn't this one play out the same way this one played out? You can't tell. That is why these indicators are lagging. You can't tell which divergence will play out, but you are bound to be sure, or you are meant to be sure, or you are to know that it will soon play out. So that is why you want to look for the lows on the RSI of the divergence, and the moment it breaks below it, and as you can see, this is just close to the 50-point mark. We have this point here, this point here, this point here, this point here, and as you can see, they are very close. They are very close together. And the moment here it came for a support as well, then it broke it here. At the moment it broke under it, what did you see, which is here, you could sell. And the moment you sell from this point, you will be in a decent profit than you could have made at this point or at this point. Higher time frame play a lot of precedence on lower time frames. So let's see what we have here. We have this side to this side. Is that reflecting on the indicator? Yes, it is correct. No bearish divergence. Everything is fine. From this point to this point, indicator is making an higher highs, right? Price is on making an higher highs. No bearish divergence. So you do not want to go short. It doesn't mean that with another strategy you cannot go short. But if you are playing strictly divergences, then nothing is telling you to go short on this trade, except if you want to sell because the price is overbought. Are you getting the point here now? So you can play the overbought game, you can play the divergence game. You can also combine them. The moment price enters into the overbought region, you want to start looking for divergences, maybe on lower time frame. Now we have price here. Let me take a rule here. We have price here making an overbought here, entering into the overbought region from here. So if you want to start looking for divergence from this point, what will you do? You go to a lower time frame. That is multiple time frame analysis. You go to a lower time frame, try to look back at that point, and then try to see if you will get a divergence. Now this point to this point, probably lower, is then this point now to this point, we have a divergence. We have this side to this side, whereas we have this side to this lower height. It is divergence. Then you want to watch for a cross down of this, right, to break below the lows of the divergence or the RSI. If you are shorted at this particular point, see the very small reaction it gives you, and then before going back to the upside. Now let's continue. From this point again to this point, we have a lower high on the indicator, right, whereas we have an higher high, this point to this point. Then we have also a break to the downside, but not much break. Now from this divergence, where is the low of this? This is still the lows, right? So the moment it broke down here, which is here, this green candle here, that is the point you want to sell on close of this green candle, because it was the one that broke and closed below the lows of the divergence. So when you identify the RSI that closed below the lows of the divergence, that point you want to sell, and if you are sold at that point, you will be in profit. And another thing is for you to be able to take profit quickly before the price decides to come back up. Now we have something we call the ED divergence. We have ED divergences that is making the opposite of what we have described. Like, I don't know if you can see an ED divergence here. Like we have, normally what we look for on divergences, we want price on a bullish divergence. We have a low, a lower high, and a lower low. Whereas on the indicator, we have a low to an high and an higher low. This is, this is what we are looking for on a normal divergence. But on an ED divergence, you want to see price. Price is the one making the higher lows. Price is the one making the higher lows, while the indicator is making the lower lows. This is a ED divergence. This is the opposite of this. In this, price is the one making the lower lows and indicator making the higher lows. But in the ED one, price is making the higher low, indicator is making the lower low. I think I spotted one just now. Okay, so let's look at this. This is an example of a ED divergence. As you can see, price was making higher lows here. Then what do this see on the indicator here? This low is this low. whereas this low is this low. So when we are to roll it, what do we see? We have a lower low on the indicator and higher low on the price. So that is a hidden bullish divergence. We have another form of hidden bullish divergence, whereas price is making a double bottom. Like we have price making double bottom like this. An indicator is either making an higher low or is making a lower low. Inverse of this is true for bearish divergence, where we have a double top. An indicator is making either a lower low or is making an higher low. This and this is not correlated here. It's not reflecting. The price is not reflecting the strength at which the price is moving. Here we have a lot of strength going up, which made the indicator to make an higher high, but then the strength pushed into the market is not reflected on price. That means there is a higher power at play. So something is probably wrong, and you want to be careful of whatever is going to play out. So those are the hidden divergences. There are many other methods at which you can trade with the RSI and other indicators, but then this is not a strategy class because we are already delving into strategies. So let's call it a video for the RSI, and then in the next video we'll look at the MACD. Thank you for being patient with us.